Hey everybody, it's Larry Berman here. It's Eat Crow week. Bitcoin flirted with 100K, and I've said for years that it's the biggest Ponzi scheme on the planet. I still believe that to be true because it's only worth what the next person will pay for it. But so far, the next person is willing to pay more. Let's take a dive into the chart room and see what we learned this week. I heard someone remark on social media that the only way to understand Bitcoin is to use technical analysis. So that's trend following, it's momentum. Um, you can throw moving averages on a chart. Um, there's lots of ways you can define what Bitcoin is or isn't, but it's definitely a tradable asset. It's more accessible than ever under the Trump administration. You can see in the last month there the breakout. If you did a technical analysis of this base pattern and estimated where it was go, a technical analyst would tell you, oh, there's a base here. Ballpark, it's $20,000, and the measured move would take you to 90, and so maybe it stalled around 90 a few days ago, and then you look at this sort of triangle here, and you project that up, and you say, well, if this flag extended, then the measured move would take you up a little over 100. And anyways, there's no shortage of ways to forecast where this might go, and the answer is it's going to go as high as the last buyer is willing to pay for it. And if I knew that, I'd have all the money in the world. So I'm a little bit humbled here in the sense that I've never traded Bitcoin. I don't want to. It's the most volatile asset on the planet. It doesn't fit with my core beliefs in terms of investing and really being conservative. But wow, it's really something to watch here, and the speculation that's going on. So how do you trade this thing? If you were going to trade it, you could look at trailing a moving average, and that works great when the market's trending, and you look back at a stock and say, oh yeah, I'll be long if I'm above a moving average. But then you look at it in a period like this, and you don't really see it, but boy, would it have been expensive whipsawing around as it cut through and in and out of moving averages. And so what is the perfect moving average to use? That's the next logical question. And it is, based on volatility. And is there an easy way to do it? And I know people are going to write notes and criticize me on this commentary, and that's fine because, do what you do. But it is quite remarkable, the Trump trade. So on that note, everyone will know who follows me on a regular basis, I am no fan of the man Donald Trump. However, I am a fan of some of the things he's trying to do. I've suggested that governments are broken. I've suggested that the fiscal outlook is tragic. And so it looks like he really wants to try to break things and fix them. And while I don't support the style that he does it in, I think he's really quite sincere in what he wants to accomplish in this administration. So, I'll applaud him for that. But again, I don't like his style or his methodology, but maybe, and just maybe, again, this is what needs to be done to break the infrastructure that has become broken. Anyways, last time around he was the swamp, and he didn't really fix anything at all. Anyways, moving on, because I know that's a touchy subject. So let's look at some of the asset classes that sort of caught my eye this week. We've had the euro for the better part of 2 years now in a bit of a range trade between 105 and 110, and it looked like it was going to break out. And what you heard here from the street is 115, 120. Again, pop here, you see 115 targets. Well, what you heard this week, again, strong dollar, inflation stronger, Fed's not going to be able to cut. You're hearing all kinds of, parity kind of commentary on the euro. And well, you certainly can't rule that out from a chart perspective. Again, you look at your base, you project your base out, and you easily come out to a move to around parity. And so for those of you looking for anti-dollar trades or things, I think let's watch the euro. Let's put that on your radar in the next few months, and let's look at the behavior around parity, and I think we can sort of push towards that. That obviously leads you to say, well, what does that mean for the Canadian dollar, Larry? And the reality is that the Canadian dollar has outperformed relative to the euro in the last couple of weeks, but it's also been structurally weak, and there's no reason for it to rally. 140, 142, if you look at the Canadian dollar. So I'm quickly bringing up that chart, and I'm going to give you a very long-term perspective on this by clicking my max bar here. So what this does is it takes the Canadian dollar back to the free float days in 1972, when we came off Bretton Woods and the currency started to float. And back then we started at parity, and it got as worse as 160, as all will know. And it spent the better part of a couple years above 140, right? And so this was twin deficits. This was a lot of structural problems with Canada that, well, we have some today. We don't have what we had back then. And so I think above 140, there's a lot of value in the Canadian dollar, but you need a catalyst. So what is that catalyst? One of them, this green line, again, this is the spread between 2-year Canada and treasuries, inverted. And so now that spread is pretty wide. It's 150 here, and you could see that spread in here got up to those levels. In here got up to those levels, but really, if you look at the average, it was kind of a lot lower than where it is today, historically. And what's my point here? The other aspect is crude oil, and then we look at it in an inverted basis. When we're looking at sorry, my bad there. I'm looking at the wrong. So 2-year spread is here, and so we're not at 150. My apologies. We're at 100. But historically, there's even on the spread, and long term, the Canadian 2-year rate is historically had to be much higher than in the U.S. And so. They had to really raise rates in Canada and keep it a lot higher to help the Canadian dollar during this period here. And that was there. So are we going to see higher rates in Canada? And, the answer is probably no. I think we need more rate relief here. So you would argue then in the short run, the Canadian dollar can bleed through 140. Again, 140 to 145, I think if you look out 5 or 10 years, you want to be a buyer of Canadian dollars. And for us here in Canada, we already own those. But when you're investing in foreign assets, you don't. And so if you own the S&P 500 and you own it at this point without a currency hedge, start thinking about hedging up that foreign currency exposure where you can in assets. And that's really the message of this conversation here. Gold had a big sell-off here, a bit on the Trump trade, a bit on what inflation was doing, and, big reversal this week. So remain very, very structurally bullish on gold. I think it's going a lot higher. Again, I think we mentioned last week we loaded up on some silver and gold names. We did some options there, so that's been a good trade this week. Looking at the Qs, we talked last week about this gap and potentially breaking down below the November low. So that still matters a whole lot. But this week, we got a little bit of correction to that, gap down last week. We got into the gap. We haven't got through it. So early next week, resistance, month end, boy, if I knew what it was going to do, I'd have all the money in the world, wouldn't I? I remain very cautious. Large cap tech in particular, very expensive here. And so when you look at, where do you move your money if you're taking it out of the NASDAQ? A couple weeks ago on BNN, I started talking about a couple ETFs here that I like, XSHQ. So this is high quality small caps. So it has a lot of the, good balance sheets, good income, good revenue growers in terms of profitability. So high quality small cap companies. These are the people that are going to benefit the most from the America First policy of Donald Trump. And so small and mid cap, I really like this. In fact, at Q Wealth, we're going to launch some funds around this for our clients to really give it a lot of focus in the next couple of years. I think there's some alpha here relative to the overvalued large cap space where you just don't see that same type of valuation in the small and mid cap names. When we look at XMHQ, so this is the mid cap, the XSHQ is the small cap. Little bit of word salad there. When you look at that, and the charts here are pretty compelling compared to what we see in the large cap names. So higher highs this week in the mid cap names. When you look into the portfolios and the sectors, why they're so different is you lack the overvalued tech and you get a lot more industrial, you got a lot more consumer. There's still tech in there, but it's not the big behemoths, right? Most people don't know any of these names because they're not in the news every day and so forth. Anyways, that's what you get when you're buying the mid and small cap quality names. You're getting America First type exposure where the vast majority of these companies aren't mega behemoths that sell their products all over the world, although there's certainly some of that. The vast majority of their revenues come from America. And if Trump is going to be remotely successful at tariffs and everything else, it's those large foreign companies that are where they sell their products overseas that are probably going to be hurt the most. And industrial America is going to outperform likely in the years to come. So that's the message of the week. Anyways, have a great week, everybody. Getting close to the holiday season, U.S. Thanksgiving, football, go Bills. Have a good one.